2026, what is actually going to be better for you in terms of accessing some equity or getting some cash or whatever use it might be when it comes to your home? Is it going to be a home equity investment or a home equity line of credit? Now, this isn't a rate debate. In fact, rate has very little to do with it. It's more of a control debate, meaning how much control will you actually be willing to have or, in one case, give up? Hey guys, I am a contributor here at The Mortgage Reports, and my name is Arjun Dingra. I'm a veteran of the mortgage industry. For 25 years, I've been helping people make smarter decisions when it comes to taking out mortgage debt and using it as a weapon for creating wealth. We appreciate you tuning into The Mortgage Reports. This is an incredible resource for all consumers and professionals of the real estate industry. Well, let's get into this big topic. So home equity investments are not as known or as much of a household name as, say, HELOCs or home equity lines of credit. Everyone's heard of a HELOC, but home equity investments work very differently, and that's because there's a lot of risk attached and methodology to this type of a product. So first, let's get into why home equity investments actually exist. One of the first contributors to why these are so popular is the fact that the interest rate environment is volatile and people don't like to have to deal with it. And when it comes to doing a home equity investment, the interest rate doesn't even matter. In fact, there isn't one. A home equity investment is based on your future appreciated value. You're basically selling a slice of your future value of your home right now. And also, with all of the lending restrictions out there, this makes for a much more appealing product. It's very quick. The approval process is pretty smooth and frictionless, but it's for a select few. It's not for everybody. So let's do a little quick deeper dive on these home equity investments. Now, there's no monthly payment. Remember, you're just selling a piece of your home's future value right now in exchange for money. There's an equity share on the exit, which means that the institution that provided you this money is going to take their cut whenever you either buy, whenever you sell your home, you refinance it, or you've just reached the end of the term and paid it off. So the cost for it is tied to the appreciation, which means there's a little bit of a loss of control. So on one hand, you have no payments, which is nice, and there's no interest rate variability that's going to affect you. You could care less, but you're losing a little bit of control or a slice of the asset itself. Okay, so now let's do a deeper dive on HELOCs. And again, HELOCs are something that most people are familiar with. This stands for home equity line of credit. It is a loan that goes into second position on a home in most cases, unless the home is owned free and clear. The payments are interest only. The interest rate is variable, and in most all cases is tied to the prime lending rate. Now, we happen to be in a cycle where the Fed is cutting the interest rates, and that affects the prime rate directly, which means that people that have HELOCs or applying for HELOCs are getting them at favorable rates all the time now. And you only make payments based on what you owe. You can also refinance it, restructure it, or repay it at any time with no penalty. And again, you only make payments, or the interest only payments, based on what you owe. So for example, if you have a $100,000 line of credit and you pulled out $10,000 to pay off some credit cards or other revolving debt, the monthly payment that ensuing month is only going to be based on $10,000, not on the 90 in difference or not on the entire 100. Okay, so let's do an example here for everybody. Let's say that you happen to be in a home that is owned free and clear and it's worth $1 million and you need $100,000. You got two options. You can either get a HELOC or you can get a home equity investment. Same house, same $100,000, just very different outcomes. So let's do the HELOC scenario first. We will assume that you had about a 7% interest rate on this HELOC. So if you borrowed $100,000, you're making interest-only payments using 7% based on the $100,000. And you keep the line open for 10 years. Now, if you wanted to pay additional principal, you would need to pay above and beyond what that monthly payment is based on the 7%. But most people don't. They just keep making the minimum payment, which is just the interest-only portion of the loan. And so the balance doesn't actually go down. So over 10 years, you will have paid anywhere between $70,000 and $80,000 in interest, depending on rate movement over the course of those 10 years. Because again, it is variable. But at the end of those 10 years, not only have you paid that interest, you still owe the $100,000 principal. But you own, and this is a sweet spot, 100% of the home's appreciation. So yes, you paid a lot in interest, but you maintained full control. Now let's look at the home equity investment over the same 10-year period. A company gives you $100,000 and they take, let's just say, 25% of your home's future value. 25% of the future appreciation. So now let's fast forward 10 years. Let's say the home appreciates from the 1 million mark to 1.5 million. That's a $500,000 gain. 25% of that appreciation is $125,000. So when you sell or refinance, you will return the original investment plus $125,000 of appreciation. So you don't pay monthly because there's no monthly payment with these products. You just pay with the upside. So it's a little bit more sophisticated and there's a lot of risk attached to it, particularly if you have a highly appreciating market that you're in. But there are some people that take advantage of this product and it can be right for some. So let's look at them side by side now. Here's what just happened. With a HELOC, you paid $75,000 roughly in interest and you kept all the appreciation. With the home equity investment, you had 0 monthly payments all along. You have $125,000 that's been given up in equity. Same house, same $100,000 $100,000, but two very different price tags. Now, to be fair, to take the opposite angle, if your home does not appreciate very much, then the home equity investment might cost a lot less. But if appreciation comes back strong, and as history has told us, that tends to be the case, particularly if we look at the last few years, the home equity investment could quietly become the most expensive money that you ever took. So, in closing, guys, the HELOC costs you interest, the home equity investment costs you ownership. So you need to choose wisely. I always recommend that you are working with a high-level mortgage advisor, not just any mortgage provider, but an actual advisor, particularly a certified one that understands markets, money, and debt, as well as consulting with your financial advisor before making any moves in this space. Hope you found this video useful and informative when it comes to what to do here in 2026, and we'll catch you guys on the next topic.